Okay, I think that's probably sufficient time for those that are planning to attend to have signed in. So good morning, everyone. Thanks for giving up your time on what, if you're dialing in from the UK, is a very pleasant day. My name is Mark Pugh. I'm head of the benefits team at the Lang, and I've got my colleague Dasha joining me today. And behind the scenes, we've also got Chloe, who's the facilitator. She's just reminded me of a couple of the housekeeping elements, that the session is being recorded. It will be available to you if you want a copy of it, but you will need to ask us for that. We won't, just as a matter of course, be sending it out to everybody. I think everybody is automatically muted, so you don't need to do anything there. The session today, we've got an hour booked in. We shouldn't keep you that long. We did one yesterday, and the technical content is around about 35 minutes, 40 minutes, and then there's some time for questions at the end. So depending on the number of questions, if we run to form, then you should be allowed a way for good behaviour 10 or 15 minutes before the hour. Today's session is talking about salary exchange. It's certainly not a new topic. Many of you will be familiar with the phraseology, or perhaps more so with salary sacrifice. And it's probably important to highlight at the beginning that there isn't really a distinction between the two. Salary sacrifice has been the more commonly used phraseology over a number of years, but we actually find that salary exchange lands better with our clients' employees. And the predominant reason for that is that I think that it's a very emotive subject in terms of salary, and individual employees are precious about their salary. So being seen to sacrifice some of that is maybe something that is an emotional challenge for individuals. Whereas actually, if we use the word exchange, and individuals can see, well, actually, no, I'm not sacrificing something, I'm giving something up, and in return, I'm getting something out that's worth of higher value, then generally we find that any salary exchange projects are better received and have higher take up and even understanding, because individuals want to engage with it a little bit more. So we're not going to tell anyone off, and particularly my colleague Dasha or myself, if we flick between the two, or if you have attended any other sessions or reading any technical documentation on the internet or in publications, that salary exchange and salary sacrifice are one of the same things. But at the Lang, we refer to it as a salary exchange. As I've touched on, it's been around a long time, and it's interesting today that when I look at the attendees, we've got a broad spectrum. We haven't just got HR benefit specialists, we've got some HR generalists, and we've also got some finance individuals on the call. So those people controlling the purse strings maybe at some of the clients or prospects that we're looking to work with. And I think that's really good news, because the emphasis of today's session is that there is some value here for both employers and corporate entities in terms of making some savings, and also for some HR teams in terms of enhancing the benefits that are available to their employees. And we all know that most businesses in difficult trading conditions are not going to have an open checkbook to be introducing new benefits. So anything that can be introduced on either a nil cost basis or even a negative cost, because there's some savings in NI, are definitely going to be easier, I think, for HR teams to be taking to executive teams and to finance teams, and vice versa as well. The agenda Dasha has put up today, everyday cost, salary exchange. I'm not going to talk through all of these items, but the key principle will flow through all of the areas that we discuss around salary exchange and how it works. And Dasha is going to cover off a little bit more around that. But I just wanted to remind people that, well, salary exchange has been around for an awful long time. The abuse of salary exchange, which was available up until around about 6 years ago, has been removed. And when I say the abuse, that there were stories and clients that we've worked with historically where clients might have been paying for their employees' school fees, they might have been paying for fancy pictures and pieces of artwork, and these were being able to be funded by a company, and then with a deduction being made from payroll for the individual employee, and enabling the individual employee to make generous national insurance and income tax savings. There was a tightening of the rules on this around about 6 years ago, 2016, and now the benefits that are truly tax efficient in terms of both income tax and NI, the best way to remind yourself of those is it's the 4 C's. So we've got contributions on pension schemes, which is the big one. We've got cycle to work, we've got cars, specifically ultra-low emission vehicles, and we've got childcare support, whether it's childcare voucher schemes, which are now a ring-fenced entity, or childcare nurseries. We're actually not going to focus on the childcare element today, but if anyone's got any questions on those, we can touch on those at the end, or we can send some further information. But the key focus today, the big ticket one is pension scheme, and then cycle to work and ultra low emission vehicles, which tick an awful lot of boxes in terms of savings for the corporate entity, savings for the individual employee, and actually probably fitting in with things like ESG policies, which are clearly at the top of the corporate agendas at the moment. So if Dasha, if you just push us on to the next slide, the reason we think it's relevant and we're carrying out these seminars at the moment, we're often having these conversations with our clients, but we think that they need to be pushed even further up the agenda at the moment, because as you'll all know, difficult trading conditions for corporates, but at the same time, the cost of living crisis for employees. If you have it within your gift to either put a little bit more money in an individual's pay packet, take-home pay, without actually increasing salary costs, then you certainly, payroll costs, you certainly should be considering that. Also, if there is a way of maybe providing some benefits that an individual would normally go and source outside of the workplace, but you can provide them within the workplace, maybe with some corporate discounts and some tax savings at nil cost to the corporate entity, then clearly it's a no-brainer. So that's the reason why we're here reminding people again today. Without further ado, I'm going to pass over to Dash, who's going to talk you through salary exchange generally, the concept, and then specifically around pension scheme contributions.
Thank you, Mark. If I can master the technology. Again, as Mark already mentioned, I will be covering just the general principle of salary exchange and how it works. And again, I'm also lucky enough to get the biggest ticket element of salary exchange, pension contributions. Again, as we are concentrating today on 3 different benefits that can be used through salary exchange, what we wanted to do to begin with is just to walk you through how the concept works in principle. So what you can see in front of you on the slide is just diagrams briefly outlining how would your payroll be structured if benefit is purchased through salary exchange and through just a normal standard payroll. So salary exchange is something that allows employers offer their employees an opportunity to purchase a benefit from their pre-tax earnings. So in a normal standard non-exchange world, the employee would receive their salary, and then this 100% salary will be subject to income tax and national insurance contributions as normal. And then the net pay will be spent on things like pension contributions, for example, or bikes, or something different benefits. And outside, the person will get their take-home pay minus the benefit they've purchased. When we operate salary exchange, obviously first point goes the salary as standard. However, instead of 100% of it being subject to tax and national insurance contributions, the system allows for the benefit to be purchased first. So first we get our salary and then the purchased benefit. As Mark pointed out, there are those big C's ones: childcare vouchers, pension contributions, cycles, and cars, electric cars. They can be purchased through salary exchange. So once this benefit's been purchased, the rest of the salary is being subject to tax and national insurance contributions. So the parts that we spend on the benefit effectively evades being subject to income tax and to NI, if we're talking about those big 4 benefits, which in the end leaves our employee with their take-home pay plus income tax and national insurance contribution savings. There are also elements when different other benefits can be run through salary exchange basis, but in this case, there is no income tax relief and there are only national insurance contribution savings. But again, that's also something that is possible. And again, if you guys are ever interested in that, please let us know. We'll be able to help support and help you with that, give you more information, provide guidance, etc. And yes, thank you already for your question. We will definitely make sure to cover a little bit, speak a bit more about childcare vouchers in the end of the presentation. So guys, thank you for being active from the very beginning. But yes, now we've walked through the concept of the salary exchange and how it works. Let's take a look at the most conventional, most common type of a salary exchange benefits, which is pension contributions. When we look at pension contributions and salary exchange, the way it generally works is that what employee does, they effectively exchange their salary, which is equal to their employee pension contribution, in return for the equal increase in the employer pension contribution. The way it works in principle is the employee forgoes the part of their salary, so say 5%, and the pension contributions becomes 0 and the employer contributions become, say, 10% if employer contributes 5 as well. This allows this ability to forgo your salary in exchange for the increased employer pension contribution, allows payroll to deduct employee pension contributions from salary before any income tax or national insurance contributions being applied. And what it's giving to our employees, income tax relief and national insurance contribution savings. So for the employee, the actual benefit will ultimately depend on their taxpayer status. Employee pension contributions are subject to, as normal, to income tax relief at their marginal taxpayer status up to their annual allowance. However, majority of conventional pension schemes that don't operate salary exchange, they only reclaim basic rate tax relief. So our basic rate taxpayers always get their full tax relief automatically. So if we run the scheme through salary exchange, the benefit for them would be the national insurance contribution savings, which for basic rate taxpayer are 13.25% as of current tax year. For higher and additional rate taxpayers, the national insurance contribution savings are somewhat smaller at 3.25% level. However, when we run our scheme through salary exchange, they receive their full higher and additional rate tax relief automatically. If they were to participate in a standard pension scheme, also known as a relief at source, it would be up to the employee, who is a higher or additional rate taxpayer, to reclaim the extra tax relief from HMRC. When we launch salary exchange projects, when we run pension presentations, we always ask the participants how often do they reclaim, those of them who are higher rate and additional rate taxpayers, how often they reclaim their extra income tax relief they're due from HMRC. And if 20% of those asked will say yes, that would be a really, really good result. Quite often people, they're either unaware of it or they just simply don't do it because it is an administrative burden. I mean, self-assessment, I guess quite a lot of people do dread it. So when you introduce salary exchange for higher and additional rate taxpayers, although their national insurance contribution savings are somewhat smaller in comparison with basic rate taxpayers, they're getting this additional benefit of their full income tax being reclaimed for them automatically. Again, loads of people don't do that, so that is a real big benefit for them. And obviously for the company, employer also makes savings on the proportion of salary the employees sacrifices, and the company savings would be 15.05% as current employers' national insurance contributions stand. To bring what we've just said, to bring this technicality in a little bit more of the real world, what we'd like to walk you guys through is an example. All the numbers are taken from real life data, and again, just to slightly put it into perspective. So in the slide in front of you, you see the analysis for our average employee with earnings of 60,000. We have taken the higher rate taxpayer in this example to illustrate the extra tax relief automatically applied. And we also looked that this higher rate taxpayer would be working for a company with an average headcount of 200 people and the total payroll of 7,400,000, average salary of 37,000. So we looked at the employer paying 4% of the 60,000 into the pension on a monthly basis, and employee contribution, now sacrifice, is at 5%. So employer and employee contribution remain unchanged, and as normal go into the pension pot. So employer contribution remains 200. Employee contribution is £250 deducted from pre-tax pay. So the total amount in our example that goes into the pension pot for the employee remains unchanged. They received a basic rate tax relief of £50, which they always receive, which is automatic. But because now a scheme is run on salary exchange, they receive extra £50 of higher rate tax relief they're due automatically without any need to go to HMRC to reclaim it. And they also make £8 of national insurance contribution savings. The company in turn makes their own savings of £38 per employee per month. It may not seem as a significant amount per one employee. However, if we'll have a look at the whole company for the whole year, for everybody participating in the salary exchange, the savings are more than 55,500, which becomes a very significant saving, which opens up loads of doors for the employers to use those savings. They can obviously keep them to cover the increasing costs of running business. We are in hard trading conditions. However, also they can spend it on some benefits. They can pass some of their savings to their employees to put in their retirement to make this money go even a little bit more further. It's really important to look at your company benefit structure when you're considering how to implement salary exchange. There are loads of ways you can structure the scheme. There are loads of ways to share employee and to divert employee and employer national insurance contribution savings. So again, that's why when you consider implementing salary exchange for your workforce, again, there are loads of ways and varieties for your business to put this in place to make sure it's in line with your needs and objectives, with your budget lines, and ultimately with your goal on retirement benefits and overall benefits delivery. So now, without any undue hesitation, I'm super excited to pass you back to Mark to talk about electric cars and cycles. I mean, I can't ride a bike, so I don't think I'll be enthusiastic enough to talk about bikes, but that's been also really on the rise. And I mean, to be fair, I think in lockdown, everybody's just been out. So we have seen some increase in bikes sales, but yeah, it's sunshine outside. It's probably maybe a bit too hot to go for a ride, but we are in summer, so bike rides are going. So I'm really happy to pass you on to Mark to talk about cycle to work.
Thanks, Dasha. Apologies, I just realised I was on mute. Yeah, thanks for that. There's some really interesting stuff, I think, on pensions, and maybe we'll come back to that just at the end when we summarise. But let's talk through the different schemes that we're going to focus on today first, and then maybe we can look at the complete picture at the end. So cycle to work. Yeah, I think as you touched on, this is something that's close to my heart as a keen cyclist. Latest count, I think 7 or 8 bikes in my garage. Around about half of which have been funded through cycle to work schemes over a number of years. For those of you that aren't familiar, cycle to work, the concept was introduced in the Finance Act back in 1999. So it's certainly not a new type of scheme or a new concept. I think some of the challenges of why cycle to work schemes haven't necessarily been promoted or been introduced more broadly across UK workforces is a combination of some of the admin challenges, some of the restrictions on the limits, and some of the urban myths that abound regarding these schemes. So I'm going to try and talk through some of those areas. Just in terms of the fundamental concept, it operates in the same way as the pension scheme contributions and the overview that Dasha already gave on pensions and the section just before that. So I don't want to spend too much time covering off that again, but the simple principle is that rather than an individual buy a bike out of net pay, the individual buys the bike out of gross pay, and therefore we get the opportunity for the individual to make those income tax and national insurance savings. Cycle to work scheme, some of the urban myths is that, well, do I need to check that my employees are using the bike to commute to work? Do I need to start providing showers and additional changing time before work starts in the morning? Absolutely not. You know, if you dig deep enough into the legislation, then maybe you will find that there is the opportunity for an audit to take place where it might be that there might be a requirement for an employer to just check that maybe an individual is using their bike for some form of commute on a single occasion every 12 months, which I'm pretty sure, well, A, we've never seen that be checked, and B, I'm pretty sure that any employer that introduced a bike to work scheme could actually evidence that had taken place in the form of, you know, cycling to the train station, actually cycling to work, or actually taking part maybe in a work charity cycle race. But the important thing is, it's not just bikes that are covered by Cycle to Work. There is also the ability to buy cycle safety equipment and also cycle clothing as well, which actually makes that requirement or that ability to check whether any element of those purchases are being used as a commute to work or almost futile. One of the reasons that these types of schemes have not taken off quite as well as they should have done historically is that unless you were an employer that had a consumer credit agreement license, so unless you were already maybe a bank or a finance house, you were restricted on the amount that could be provided to an employee in the form of a Cycle to Work voucher. It was capped at £1,000, but in 2019 that was removed. For any keen cycling enthusiast on the call today, £1,000 probably doesn't get you that much in terms of a bike, you know, if you are someone that is very keen on cycling. So I think some employers were a bit nervous about rolling out a scheme and then as a positive, but then actually receiving feedback that it wasn't appropriate for their particular employees because they actually wanted to spend a little bit more on bikes. But as I say, that cap has now been removed. And the great thing about that is even more beneficial for employees, but the more that the employees spend on the bike, actually it's more beneficial for employers in terms of making those NI savings as well. Historically, there has also been challenges around some of the admin fees that the Cycle to Work providers were actually taking as a charge for running the scheme. And actually that negated some of the additional saving. And therefore it's one of the reasons why some clients chose not to introduce Cycle to Work schemes historically. What we're seeing is both competition, but then further consolidation in the market with those providers. And whilst there are just some providers that don't offer the actual purchase of the bike themselves, just the voucher scheme, so they don't have a retail offering where they're actually selling bikes, those schemes generally still need to levy an administration charge, which can be quite unpalatable on either the employer or the employee at the end of the Cycle to Work period if there's an additional charge that they need to bear. So what we actually find is that there's a couple of Cycle to Work providers that will also have retail arms. So examples of those are Evans Cycles and Halfords, where because they are actually driving traffic through the voucher to their own retail outlets, they're going to actually end up making some money on the bikes themselves. They can therefore remove or waive any admin charges in the scheme itself. And that generally means that it's a better deal for both the employer and the employee. So, you know, we can help you find the right scheme for your guys. And other things to factor in are, you know, whether there is the retail outlets that are close enough maybe to your head office. And we also know that, you know, a lot more and more people working in a hybrid environment, or more and more businesses have got a wider geographical spread of employees. Then it's important not just to have the retail stores, the Halfords or the Evans Cycles, to also have an online presence and maybe access to independent cycling stores as well. So both of those, Evans Cycles and Halfords, have been quite canny here, made sure that they've got a good online presence. Halfords bought Treads, which was a major online provider of bicycles and equipment. And they've also signed up around about 1,000 independent stores across the country. So you can get your voucher through them, but actually you can then go and use it in your local independent store, or you can use it online as well. Online is often, you know, ideal because a lot of the online stores actually will have price match or price beta guarantees as well. So providing that full range of options for an individual, whether they want to go down and use the expertise of the local bike shop and support an independent, whether they want to go to a big trusted high street name such as Halfords, where, you know, they're still going to be there in 20 years time, even though high street presence is diminishing, or whether they want to go and source something online and are happy just for it to be delivered and sold as seed. Some really good solutions out there. The key thing to focus on in terms of when you promote this internally is the substantial savings for individuals. But, you know, as Dasha touched on, cycling is incredibly popular in the UK and many other countries around the world. We've had an absolute boom in it, which was then further exacerbated by COVID and the lockdown. An individual basic rate taxpayer that takes out a Cycle to Work voucher will be saving 33.25p on every pound they spend on that voucher. So if they're going to spend £1,000 on a bike, or, you know, £600-700 on a bike and £300 on a helmet and some clothing, then actually they're going to get that for pretty much 2/3 the price. And they're also going to get the benefit of a big ticket purchase being spread over a period of time, typically 12 months, and coming directly out of payroll. So an absolute no-brainer. Once you go further up the food chain in terms of earnings and spend on a bike, we've got a couple of football club clients. They've actually decided that they are going to set their limits at £15,000. People that are spending £15,000 on a bike, you can see that they would typically be additional rate taxpayers. So for those individuals, there is 45p in the pound income tax saving, 3.25% in the pound national insurance. So in total, 48.25p in terms of direct savings. So a £15,000 bike, in effect, costing them less than £8,000 in terms of real cost to them when you factored in the tax savings. And on top of that, there is the NI savings that are available to the employee or the corporate entity as well. Going back to my point earlier, which is why it's so good to have some finance guys, those controlling the purse strings, on the call today. That's all I'm going to say about bikes, but we can take any questions at the end of the session. Okay, the next area we're going to cover on is ultra-low emission vehicles, growing in popularity, becoming a more relevant conversation piece with pretty much every client that we are speaking with. The reasons being, it ties in nicely with corporate ESG policies, but also there is some significant savings for both the corporate entity in terms of potential NI savings, even though lots of clients that we're working with are actually sharing those back to the employees to further reduce the cost of the car, but there is a choice of whether companies want to do that. But there also is some valuable VAT savings as well. So if you're a VAT registered entity, then there's some valuable VAT savings by introducing salary exchange on electric vehicles. Companies providing company cars or car allowances over the last 20-30 years, the tax benefit in doing that has been generally reduced, so that now actually the provision of a car that isn't environmentally friendly or the provision of a car allowance is pretty much taxed in the same way as a regular pound of salary is. Ultra low emission vehicles does have that benefit of full income tax saving and NI savings, with the slight caveat that there is a benefit in kind of 1%. It was 0%, it's moved up to 1%, and over the next 2 years, it's going to go from 2 to 3%. The justification for that is that these type of car deals will generally incorporate or include insurance and road tax, and those elements are seen as actually being a genuine benefit in kind to the individual. But to give you an idea of an example of on a standard car, I think the slide should actually say a Volkswagen, unless they change the name, a Volkswagen ID.3 Life Pro, with an employee who is a basic rate taxpayer, so earning less than £50,000 a year. If we look at that example of securing a car through a company car scheme, then the monthly cost around about £483 a month on a 4-year deal. If the individual was trying to source that externally on their own, just by walking into a car dealer, the likelihood is that that 483 would actually be a higher cost, because there is the element of corporate discount, because if as a corporate entity signing up to one of these schemes, then the car dealers are more keen to work with you because they're expecting a higher volume. The net impact on the individual is a drop in take-home pay of £333 a month. So actually a saving of broadly £150 a month. The £5 difference there is this benefit in kind and this element of car tax that I mentioned earlier. So what we're saying is that not every individual in your workplace is going to all of a sudden want to source a car through the company. But it may well be that you can dovetail or overlay this scheme with schemes that you've already got in place. We've got a number of clients that maybe provide a company car to execs or senior management, part of their ESG. There is a desire to meet some sort of carbon neutral requirements in the future. We're seeing that some of those entities say, well, actually what we're going to do, we're going to mandate those that are entitled to a company car provided by the employer to only have accessibility to an ultra low emission vehicle. If they choose not to take that car, then we'll actually make it mandatory that that's the only type of vehicle that they can have. So promoting their ESG policy, promoting a very tax efficient benefit, but then maybe also then rolling out the scheme on a voluntary basis for the remainder of their workforce, and thus taking a valuable benefit to their employees where there is savings, but also savings for the corporate, the end employer as well. Some of the challenges we've had around these schemes over the last few years, and the reason that some clients have been nervous to introduce them, is that people wanted to see what the end of COVID and hybrid working might look like. There is a lot of noise at the moment around there being a shortage of new cars and chips, and therefore you roll out a scheme, you put wide availability on a number of cars that an individual might be able to choose from. But in the words of, I think, Henry T. Ford, you can have any colour you want or any model you want, as long as it's the Model T Ford and it's black. There was a danger that the feedback from employees may well have been, well, it's great we've introduced this scheme, but actually I can't get the car that I want. We have seen what we do know is that priority for those chips, and I'm not going to get too technical in this area because I'm certainly not an auto enthusiast or expert, has been given to ultra-low emission vehicles. So we are seeing gradually wider availability for ultra-low emission vehicles. The other challenge that we saw is that historically, some of the clients, we work predominantly with the small to mid-market sector in the UK. And we've had conversations with clients where they thought that actually the admin side of this, the cost, any risk to the business, maybe it's the domain for larger employers, and some of the actual providers themselves were only targeting employers that maybe had more than 200 employees. That's been scaled down now, and we partner with a number of providers that are willing to offer ultra-low emission vehicle schemes for clients with more than 50 employees. We're going to talk a little bit more around the take-up and what the expected take-up levels in the next couple of slides. But just going back, in principle, the concept is the same. It's a bigger ticket purchase than cycle to work. So a little bit more risk and thought in the promotion and the introduction of the scheme for employers, whether they need to set certain rules around an individual already being employed for a certain length of time, whether it's certain categories of employer based on maybe hierarchical structure or seniority or earnings. We can help with all of that in the design. And I think the important thing is that we should be having a conversation around whether there is some benefit both for employees and the employer of introducing ultra-low emission vehicles or ultra-low emission vehicle scheme. We know that if we're trying to look forward with the crystal ball in 10, 20 years' time, these schemes are going to be incredibly popular. Okay, that's me on ultra-low emission vehicles. Dasha, back over to you.
Thank you, Mark. So as Mark said, what we'd like to do as well is to put again all the technical information we gave you guys into a little bit more of perspective, and to walk you through how would implementation of cycle to work, pension scheme and electric cars for salary exchange, how would it impact an average employee? Again, so what we have done, we had a look at, to be fair, real market data. So all the numbers here are based on the existing situation. So we looked at the average employee with an annual salary of £37,000, which would be a market average for the UK, with pension contributions of 5% employee based on their annual salary. 5% is, to be honest, the most common employee contribution, regardless of the pensionable salary you choose. Could be base pay, could be total earnings, could be qualifying earnings, but the most common contribution for the employee would be 5%. Cycle to work voucher of £1,500. And again, although Mark mentioned that probably is, again, a little bit not enough for a cycling enthusiast, and it's definitely not enough for somebody who's got 6-7 bikes in their garage. But to be fair, we do see 1,500 as more or less a real average representation of the average voucher. And the electric car cost of £483 per month, using the Volkswagen example from the previous slide. So if we were to take this average employee participating in the pension scheme and also participating in electric cars and cycle to work, the overall savings for the employee in tax and national insurance will reach nearly £3,000, which again is completely incredible. Just to kind of mention, guys, obviously £370 income tax savings, that's just naturally what would be given to this employee, because they are a basic rate taxpayer. So the tax relief is just automatic regardless, but the national insurance contribution savings is definitely an extra for this person per year from salary exchange. In this example, the biggest driver for the savings would be the electric car scheme. But again, to be honest, even though the fuel prices are rising and we talk about climate, there's still loads and loads of cars on the road. So again, if you know that one of your employees are interested, say, in going into privately leasing a car, actually, and doing something through the company car scheme will be much more tax efficient for them. And again, the amount of cars on the roads, it's not going down, it's only going, well, I wouldn't say it's going up, but it's definitely staying exactly as it is. It's just more and more cars are turning green. So it's definitely a great initiative to look to introduce to your employees. The other situation that we wanted to bring in live is how the participation in salary exchange will affect the company itself. And here we will talk about average take-up levels. So the company example on the slide, which is again also a real data example, is the company you've seen on the pension contribution slides, is the headcount of 200 employees and total payroll of 7,400,000. And with the pension uptake, we've calculated at 100%. To be honest, if majority of companies that introduce salary exchange, the uptake would be at 96 to 98% levels. The only people choosing not to participate in salary exchange are those employees whose earnings are not big enough, and participating in salary exchange will push them below the minimum wage, which is impossible. So again, if you don't have any employees on minimum wage and everybody's on a higher remuneration, then 100% uptake is completely possible, although again, a full figure. Cycle to work uptake as a standard, probably if it's properly communicated, would be at 4% per year. It's not a lot, not significant, especially in comparison with the pension scheme. However, you do see those uptakes come and go in waves. When the scheme is launched, the uptake will be higher. And if the scheme is launched in, say, spring, yes, the uptake will be higher. Everybody's awaits for nicer weather, for more bikes, for more opportunity to go and to take your bike for a ride and things like that. If it's launched in October, I mean, everybody's getting ready for Christmas, and the weather is getting colder. So again, the uptake may be a bit low. But again, with cycle to work, it does go in waves. And with the electric car uptake, we've taken the uptake of 2%. Normally, when the scheme is launched, we can expect up to 8% uptake. However, the average length of the lease for the company car would be 8%, and because average length of the lease would be 4 years. And because the person who decided to participate in the scheme is in it for 4 years, we've simply divided 8 by 4 to give you a good weighted annualized figure of 2%. Introducing those benefits with our average uptakes will give the company a total savings of nearly 61,000. Obviously, the biggest driver would be the pension savings, closely followed by electric car savings, and then by cycle to work. Excuse me. See, I'm still coming out of the cold. I probably should go on a bike and be a bit healthy. Yeah, so again, that's the savings are absolutely significant. And as we previously mentioned, there are loads and loads of ways those savings can be utilized further. Some of those savings can be passed down to employees as form of pension saving and increased retirement contributions. Obviously, our pension savings, the investment is free from income tax. So again, it makes those money go a little bit further. But again, it also can support you in strong trading conditions, or can be spent on introducing different benefits. But I guess one of the main messages that we wanted to talk to you guys today, although the situation is getting harder and the cost of money is getting unfortunately cheaper and cheaper, the value of money is getting cheaper, but the cost of goods respectively rises. There are certain changes to your payroll you can do to find those extra funds to support your company and your employees in this unstable period. Pass back to you, Mark.
Thanks, Dasha. Yeah, so when Dasha and I were discussing the slides and trying to put some of the examples together, it is a real challenge, and we've probably been, a little bit cautious or prudent in terms of the assumptions that we've made. It'll be clear to all of you that the point that we're trying to articulate here is there's some sizable savings. I know, just doing a little bit of research on a couple of the attendees on this call, that there are individuals involved that are working for businesses that have got round about 200 employees. So hopefully this has hit the mark in terms of giving you an indication of what the savings might be. But the pensions uptake, we can get, as long as you haven't got a lot of individual employees that are maybe on temporary contracts or have got massively fluctuating earnings, that we can typically, with a well-communicated exercise, get close to 100% pension take-up. The 5% figure that we use, some of you might think, well, actually, our employee contributions are a little bit less than that. But when we factor in that salary exchange can be rolled out over bonus sacrifice or bonus waiver schemes as well, and in addition, what we typically find is that higher earners in businesses are actually those that are lucky enough to be able to afford a little bit more in terms of retirement savings. So actually, whilst your standard rates might not be 5%, if you look at your standard employee rates, in reality, when you factor in the additional contributions individuals are paying, you might actually find that the 5% is prudent. The cycle to work, Dasha talked about it, it depends on how you promote it, when it's launched in the year. New schemes we will typically see, and depending on the demographic of your workforce and the industry that you're in, but new schemes we can often see 8 or 9, and we've even hit double-digit 10% take up in year one. But we know that will then tail off in future years as well. So the 4% is a prudent figure. And the electric car, we have got clients where we're seeing that maybe the electric car take up is as high as 4 or 5% in year one. Maybe in those types of instances where I spoke about, where there is a mandation in terms of senior employees in the business setting an example or providing some rules around the scheme that doesn't allow those employees to go and source a less environmentally friendly car at the cost of the company as well. What we're trying to highlight here, that you look at that average type of business, have you had the conversation recently? Have you, have HR and finance spoken together around, are the schemes running efficiently as they could be? Are there some new schemes that we can introduce? 60,000 is not an insignificant saving. I'm sure that HR teams will be thinking, wow, if I get my hands on that and I can spend it on other HR projects, fantastic. I'm sure finance teams will be thinking, wow, if I can push the HR team to make the benefit cost £60,000 more efficient every year, then it's a win-win. We're just trying to remind people of some of those schemes, open up that conversation. Still absolutely amazed on when we speak to pension scheme providers. So if we remove, any of you on there that maybe have got legacy defined benefit schemes, the salary exchange is a little bit more complex and you've probably already got it in place. But most employers today are running some form of group personal pension plan, contract-based scheme with the main providers out there or in a trust environment. Those schemes, we're still hearing that for small to medium employers, so those sort of 50 employees up to 1,000 employees, take-up rates on or implementation of salary exchange is still only around about 60%. It amazes me that more companies aren't saying, well, let's at least have the conversation to see whether this is something that we can get some additional value out of. One of the challenges I think we've had from clients in the past is that, well, we'd like to get around to this, but we've got too many other priorities at the moment. It's not core business for us. We'll address it at some point in the future. Or, well, actually, it's a tax relief. We know that consecutive governments are struggling and are looking down the back of the sofa for some more money. Are we going to spend a lot of time launching these projects, changing our schemes, only to find that the actual tax advantages are withdrawn at some point in time in the future? That's absolutely not the case. Consecutive governments of all different leanings and colours have confirmed over the last 20 years or so that national insurance and income tax incentivisation or tax efficiencies for these arrangements where you still get the full benefit. Each government has confirmed and opposition that they are committed to supporting these in the future as well. Okay, that's probably all we were going to say. We've probably taken a little bit longer than we'd hoped to, so apologies and thank you for everyone for staying on the call. We're going to open up for questions. There was one specific question that came through around childcare, and hopefully I can cover that off relatively quickly. So thank you, Dirk, for that question. In terms of childcare, there used to be, or there still is, something called a childcare scheme where individual employees can get full tax and NI relief on contributions up to £123 a month if you are a basic rate taxpayer, or £243 a month if you are a high rate taxpayer. However, that scheme was closed a number of years ago. So employees that still have access to that scheme can carry on making those contributions and get the tax advantages. However, no new employees can join those schemes. So we haven't really gone big on that, even though it was a really attractive benefit historically. There isn't much more to say about that, really. The government replaced the schemes being provided by employers to a scheme that the individual employee can now access directly through the government website, through a government gateway. They can put in their own details around earnings and dependent responsibilities. And actually there is then an adjustment in the form of a tax code. So actually it's not an employer related or sponsored benefit these days, but you should still be aware of that. At the other area, which is still incredibly tax efficient, but probably is the domain of the much larger employers out there, is on-site childcare nurseries. We know that there's businesses out there, you know, some of those major employers, super employers in the UK that maybe are employing north of 5,000 or 10,000 employees that have still got a large presence on site, maybe at head offices or at regional large offices, that providing creche or childcare facilities in those environments can be incredibly tax advantageous. And there is no liability on the individual employee in terms of NI or income tax. However, as you can imagine, there is a significant cost in setting up and running and administering those schemes, and that's why they're probably still the domain of the larger employers. So hopefully that covers off your point, Dirk. Is there any other questions? Does anyone want to type anything in the question answers or the chat? We'll give you a few seconds to do so, but just whilst we're waiting to do that, hope you found today's session relatively interesting, a little bit of a reminder or refresher, or just a bit of a deeper dig in terms of the knowledge that you already had in respect to salary exchange. Dasha and I and the rest of our team are on hand if anyone wants a conversation. If you're thinking of launching a scheme internally and you're thinking you don't need an advisor support, we're not going to be offended, but we do know what some of the pitfalls are. We're more than happy, you know, our business is about building relationships. We're more than happy if you want to pick up the phone to us and say, just think of introducing this internally. You know, can you give me a steer whether, you know, we're on the right lines? You know, and if you don't want to engage us to formally support on that, then we're more than happy to give you, you know, 15 minutes, half an hour of our time and our expertise to help you out. Okay, we haven't had any more questions come in. So on that note, I think we will say thank you and give everyone a little bit of their day back and hopefully enjoy the sunshine. I think there's a bit of a north-south split today, with the north is still sunny and the south is about to see a little bit of rain. But thank you again, everyone. Enjoy the rest of your day, and please feel free to get in touch if you've got any questions.
Thank you, everyone.